Hello everybody, welcome to Northwest Quadrant Wealth Management's e-news. Thank you for joining us this weekend, this Memorial Day weekend here. It's going to be beautiful here in the Pacific Northwest, and hopefully wherever you're watching this, it's nice where you are. Today we thought we'd talk about what's going on in the markets right now and the probable volatility we're going to see in the markets. What we don't want you to take this video as something that you need to be doing something dramatic or that we're worried about markets out into the future. We do want to talk about the price earnings multiple in markets, and then we're seeing some crazy things happening in certain meme stocks again, but only to prepare you, our clients, for probably some market volatility in the months ahead. So, markets, the S&P 500 is trading in the high 30 times earnings, 38 times earnings, which if you look back throughout history, it's some of the highest multiples we've ever seen in markets. We'll see stocks can get cheaper one of two ways. Either earnings can continue to grow and the E part of the multiplier will go up, or stocks can go down. And so we're not sure which is going to happen, where earnings will continue to grow or stocks can go down to make stocks cheaper. But we do know one of those things probably needs to happen in order for stocks to be reasonably priced. We know that the month of May started off rough, but as we sit here today, markets are trading really close to all-time highs again. And this week we saw some of these crazy meme stocks like AMC, the movie theater chain, which is a terrible business, traded over a $10 billion market cap. It's up an insane amount this week, and a lot of it has to do with that Reddit crowd, Wall Street Bets crowd. So markets are expensive. We want you to prepare mentally for volatility. We don't know the catalyst that's going to create the volatility in the markets, but Josh can talk about some of the things that we're looking forward to as maybe potential volatility creators.
With the 3.1% inflation print coming out this morning, one of the things that we look towards over the summer that could potentially create volatility is the beginning of tapering. What that means is just a little bit less bond purchases by the Federal Reserve, i.e. less money creation. 2013 seems like a really long time ago. I was in my mid-20s, Tyler had less gray hair, and it feels like forever ago, but that was the last time the Federal Reserve actually engaged in tapering. And back then, we had some pretty significant volatility at the beginning of the year as the market kind of tried to determine what the outcome would be. And by the end of the year, the S&P 500 finished up almost 33% for the year, but there was a bit of uncertainty surrounding that at the beginning of the tapering, and that could potentially be the catalyst. The Fed meets in Jackson Hole this summer. That's when the market is actually anticipating they start to talk about tapering, and then tapering itself likely won't actually begin until later in the fall or perhaps in 2022. But remember, markets are forward-looking, so market participants are going to be engaged in whatever they choose to participate as the outcome when tapering gets announced this summer.
So it's interesting, like Josh said, we got a higher than expected inflation print this morning. But interest rates really didn't go anywhere and stocks didn't sell off. So markets are really looking to what the Fed is going to do with their balance sheet and with interest rates more than almost anything else as the determinant of where markets are going to head. Mostly we want you to take away from this that we are expecting volatility to the downside in the coming months as markets adjust to the fact that the Fed's going to stop probably buying $120 billion a month in bonds, and at some point we'll have to raise interest rates and markets will have to readjust to that. So we expect some volatility. It doesn't mean that we think you should be doing something dramatic with your money, all in or all out kind of thing. We really feel like our portfolios are positioned in a really good place. We're globally diversified. We own stocks up and down the market cap spectrum, which have historically done well in inflationary times. And we also own quality, and then on the bond side of our portfolio, we really feel like we're positioned well there as well with short duration and some inflation protection there. So as always, if you have questions about your situation, call our office, 800-743-0988. And we'll see you back here in 2 weeks. Everybody have a safe and fun holiday weekend.